You may know that some of the world's biggest companies pay almost zero tax in the countries where they make billions in sales. But the question is, what is the secret? It's not offshore bank accounts. It's something far more powerful. The intangible assets. In today's video, we're uncovering how intellectual property, like patents, software, and even brand names, helps multinational corporations legally move profits to low-tax jurisdictions. Hello everyone, and welcome to TaxGate. Here, we like to simplify local and international tax topics. Hit the subscribe button, and let's get started. Well, so, why intangibles are so powerful? Intangibles are high-value, portable assets. And because they are digital and mobile, they can be transferred across borders with the click of a button, making them the perfect vehicle for profit shifting. This flexibility makes them ideal for allocating profits to favorable tax jurisdictions. And now let's understand how it works. Multinational enterprises often assign legal ownership of valuable intellectual property to entity in low or preferential tax jurisdictions, normally called IP holding company. Once ownership of the IP is placed in the low-tax jurisdiction, other group companies around the world start to pay royalties or license fees to use that IP. These royalty expenses or license fees would be considered as a deductible expense in high-tax countries, which accordingly reduce the taxable income. And at the same time, they are recognized as income in the low-tax jurisdiction, where they should subject to lower tax rate. Well, another approach to be highlighted here, which is when multinationals use cost-sharing agreements. Here, several subsidiaries would split the costs of developing an intangible asset. And despite the fact that the subsidiary in the low-tax jurisdiction may contribute a nominal amount toward the research and development activities, however, the potential profits are often allocated to the entity in the low-tax country, even if most of the R&D activities happened elsewhere. Sometimes, companies go even further by restructuring and transferring existing IP from a high-tax jurisdiction to a low-tax jurisdiction through sale or contribution agreements, normally at valuations that tax authorities may later challenge. Here, the transfer price is supposed to reflect the arm's length value. However, determining the fair market value of intangibles would be complex and open to interpretations. So, due to the fact that the IP is difficult to value, the transfer price can be understated, which accordingly reduces the exit tax in the high-tax country. Also, some structures use the differences between countries' tax rules to obtain double deductions in multiple countries for the same payment, or to ensure the income is not taxed anywhere. Well, these strategies are not about hiding money. They are about structuring income to flow through places where tax rates are favorable. But today, with the OECD's BEPS initiatives and stricter transfer pricing rules, tax authorities now demand that profits should match where real economic activity and value creation actually happens. So, what do you think? Should governments tighten the rules even more, or are these just smart business strategies? Drop your thoughts in the comments below, and don't forget to like and subscribe for more insights into international tax and transfer pricing, and thanks for watching TaxGate.